Hi traders, this is Ryan Littlestone from Forex Analytics, doing the week ahead video for the 1st of July, getting you set up for the week ahead and having a little look at what went on the previous week, and we'll look at some markets and see how currencies performed and where we're left after all the events of last week. I'm going to start with what's been going on with some of the speakers, the central banks. We had another big session of central banks during the week at the Sintra event, the ECB event. But on top of that, we had a lot of ECB speakers coming out, lots of members coming out in force, pushing the same old narrative for July hikes and making stronger remarks even for hikes to potentially come in September. During the Sintra powwow, we had that big meeting between Powell, Lagarde, Bailey and Ueda. And it was a good bit of insight to hear from some of them in a bit more relaxed atmosphere. They were questioned very well by Sarah Eisen of CNBC. She did a really good job, really sticking it to them there. And a lot of people wishing that she could take over some of the monetary policy press conferences that we hear about every month, because she really did put some good questions forward. So just running through the different central bankers, Lagarde, she continued her message for rates, keeping the higher for longer message in there really strongly. Also, pretty much nailed on for a July hike, which is no real change to where we are coming into this. And she went again to rule out any premature rate cuts, be it the early parts of next year or even towards the end of this year. Some of the market had been trying to guess that maybe the end of the year we might see some cuts from the ECB, but that's pushed well out by Lagarde on that front. Powell as well, he was quite jovial, and he again maintained his line that the dots forecast 2 more rate hikes. But he made it sound a bit more like it was more likely than not that we were going to get 2 more hikes. When those hikes come, as ever, we're data dependent, but it looks like we've got 2 more in the pipe. Again, like Lagarde, making it very clear, cuts are not in the Fed's thinking at all. And that's the theme for a lot of these central banks, is that they don't want to give the market any sort of ammunition to go against the current policy stance from these banks. Now, what was interesting is we heard from Bank of Japan's Ueda, pretty much the first time that we actually hear what he's got to say outside of a monetary policy meeting, which obviously usually conducted in Japanese. And the key comment from him is that he still expects inflation to pull back in the second half of this year, second half of the fiscal year in Japan, but then rise again into 2024. And the key point he said here was that if they became reasonably sure about the second part of their inflation forecast, i.e. this move back higher in 2024, that would be a good reason for them to reconsider a policy change. He also added that when it came to raising rates, they may go up in large margins. So that really told us something about what conditions they are looking for before they tighten policy. Now, for me, that view might be accelerated if we don't see the pullback in inflation to levels that the Bank of Japan still think it will get to, i.e. back under 2%. So, like everyone else, we're going to be watching the data on that front. So, going to have a little look at the data as well, which you can, let me get my mug out of the way there. And looking at the data, we did get some data from Japan, early June readings in CPI via the Tokyo CPI numbers. And as you can see there, a little bit softer, some mixed, some unchanged, some a little pip off, if you like. So we got one measure, the core CPI came in unchanged at 3.2%, was expected to go high, but remained unchanged. One of the other measures we got there in the CPI, as you can see, the headline Tokyo CPI number there coming down a pip to 3.1% from 3.2% prior. There is another number. This is an X everything, a core, if you like, CPI number, and that pulled back to 2.3% from 2.4%. That one may be a little bit closer to the Bank of Japan's current inflation target than they would like, but it is a Tokyo measure, so it's not for the whole of Japan. But as I say, the first numbers from Japan for June, it still keeps inflation pretty sticky, keeps it above that 2% mark, and that's what the Bank of Japan are really going to be interested in. We also had some first numbers from the Eurozone, inflation numbers from the Eurozone. France got the ball rolling, and it's been a little bit mixed on the inflation numbers so far. France coming in lower than expected in both the CPI and the HICP measures. That's the Eurozone measure there. The Eurozone number came in as well. Again, pretty much the same, lower than expected, although the core rose by a pip, but not as much as it was expected. It was expected to go from 5.3 to 5.5%, actually came in at 5.4%. So it still went up. This core measure still went up, and that's very important because that's what the ECB are focused on at the moment. So even though the headline came down more than expected, that core is still very sticky. Now, it was a mixed bag because early in the week we got Germany's inflation numbers. Their inflation went up quite significantly. However, what we saw in those numbers were some effects from last year where they placed some transport subsidies, gave cheaper tickets to people in Germany in this period last year just to help with costs. So that obviously artificially took down inflation last year. Now we're seeing the reverse of that this year, hence why we've seen those larger readings. That may continue for a couple of months and then we probably see that wash out again. So it's made the picture in Germany a little bit tougher to read in that sense. Then over to the US, and we got the US PCE numbers, the data that we were all waiting for on Friday. And again, it's telling a sticky story. Core PCE dropped a pip to 4.7%, to 4.6%, was expected to come in unchanged. Headline PCE, that was a little bit wonky because expectations there were for a 4.6% number, which was a bit of a misnomer amongst a lot of the calendars. It wasn't set that high. We don't know where that 4.6% came from. Powell even remarked during the week that it was expected to come in around 3.9%. Most of the calendars had the expected number about 3.9%. It came in less at 3.8%. So that confirmed the drop there, but that core number still staying very sticky, only a point down on last month at 4.6%. Now, also, we got the final GDP numbers for Q1 from the US as well. Not normally something I look too closely at, but we did get a big change in the number. It moved up to 2% versus 1.4% prior. Very unusual to see a final reading jump that much, but good solid numbers and keeps the wolves from the door as far as the US is concerned. Looking at the jobs front and the weekly jobless claims number, we had been seeing that number ticking around the 260s, between 260 and 270 for a few weeks, looking like it might just be starting to edge higher. It came in at 239. You just can't keep a good jobs market down in the US at the moment. So overall, taking all the data into consideration that we got this week, the data needle really continues to point to soft landings, particularly in the US, but other countries as well, not doing too bad either. Inflation is still largely dropping, though we're still getting those core sticky numbers. All of that overall means nothing really in the change of rhetoric from central banks. They're going to be continuing to push their hike pass for those that are still hiking. They're going to be pushing their higher for longer for those who may be going on to pauses. So price-wise, have a little look at some of the major currencies and how they did over the week. Really, there's been little change amongst the majors, modest percentage changes this week. The dollar had some small gains, as did the euro and sterling, as you can see from the charts over there. What stands out from looking at these numbers really is that FX has been a loser in nearly all aspects. A lot of the commodity currencies, Kiwi, Aussie, CAD, they've all been really doing not so well this week. And I think that tells us something about the global economy. It tells us that we are seeing a bit of weakness, and we know that because we've seen that in some of the manufacturing data, like the PMIs that we've seen recently. So really, FX taking it in the neck a bit there. That's a sign, as I say, of what the global economy is looking like at the moment, and all commodities haven't been doing particularly well either. For the yen, now I'll just move my mug again. It's still been weakening, but not as much as it has been in prior weeks. So not weakening as fast. We're still seeing some weakness there, still a lot of green, as you can see there. But there's a few more currencies that have gained actually against the yen this week. Now, we could maybe suggest that this weakness is maybe running out of a bit of puff somewhat. We have had end of month, end of quarter, end of half year. That may be playing a bit of effect in some of these moves this week, particularly in the yen. But this could be early signs that maybe we're reaching some limits for the moment in where sellers really want to take this. So let's have a look at some of the charts, and going to start off with dollar yen. Again, let me get my mugshot out the way. So really the big action that I think we need to pay attention to here is this big 145 level. A lot of people in the market were looking at this number. A lot of people were thinking, you know, this is going to be the level where the bank are going to come in and intervene, or rather the Ministry of Finance was going to come in and intervene. We saw a lot of bit of action around there as we first approached it. We got up to sort of 144.70s, and it got a big slap back off of that. Then we hit 145 over the Tokyo F.A.C.E, the last of the month on Friday. That took it just up through 145 to 145.07, but we've hit it and we're below it and we've closed below it, and we're down at 144, close at 144.20s, 26. I think it's looking quite significant, that move. The reason why this is a big level, not just because a lot of the market have penciled it as a possible intervention level, is that technically it's a big level. And I've been highlighting this all week in our chat room. If you go back into the latter part of last year, from September through October, you can see there it was a real solid point in the big move up for dollar yen. You know, we spent a couple of months trying to get through that area. When we did get through that area, that's what took us right off to those highs up there, and then eventually brought the Ministry of Finance via the Bank of Japan steaming in with intervention. So it's early days, but it could be a bit significant that we have actually held this level and we've closed below this level on the week. If we are starting to see yen weakness running out of puff, be it temporarily or otherwise, this could form into a real solid level. If we find that that does, then we're potentially on for a steeper pullback. Maybe we get down to some of the juicier levels a lot of people might be waiting for, down in the 140s, down at 138. For me, I'm taking a longer, wider look at this one at the moment rather than looking at the smaller levels in between. The key level for me is still down at that 138 level. We're a long way away. There's plenty of traffic in the way. But if you see, we've got the 38.2 fib of this latest move that came in from March. That's down at 139.16. So a long way to go before we look to at least try and turn around this trend that we've been seeing back since March. Coming over to euro dollar, and not an awful lot going on really for the euro dollar. Haven't really looked like we were going to have a big move up towards 110. Neither have we had any major signs that we're going to disappear down back towards 108, 107s, that sort of area. So coming through all this data, coming through the central banks, you sometimes need to take a step back, look at what a market is doing. And for now, it looks like the euro doesn't want to do an awful lot. Maybe we're just starting to hit summer markets, and we're going to see volatility dropping back further. That can mean we get some decent ranges setting up for the euro dollar. At the moment, I don't see any real reason why we need to make any big moves. I was looking towards month end, maybe for a move above 110 to get into some shorts, just really to play the range. Anything up to 111 would have been a bit of a gift in my opinion, but didn't even get close to that in the end. Same on the downside. 107 is my big marker to the downside here. Not remotely getting close to that this week. So I think traders have got to set their sights a little bit lower if you're trading euro dollar as to what you might gain out of it. The ranges are pretty decent. I've got this blue zone here, which I've had in my charts forever, between 108.30, 108.70. It's one of those areas where the price, tends to have a little bit of a mooch around when we get there. Sometimes it will get down to 108.30 and hold it on a first test. Sometimes it will bounce back up to 108.70, hold that on a first test. So it's one of those traffic zones, and you can use these types of zones as a bit of a pivot area. If you find we're above and holding above 108.70, that gives you a bit of conviction to maybe try longs into there, see if you can get a move above 109. Conversely, get below 108.30, find that that's confirming below by retest of that level and it's holding, gives you conviction to try some shorts, maybe get a push down to 108 or into that 107 area. But by and large, I don't see any real fundamental reasons why this is going to move out of its current tight range. We know what the ECB are doing. Despite the fact they still remain hawkish, we got an idea of how many more rate cuts are likely. Maybe another 2, at most maybe another 3, but then I think we're into pause territory. And that's really where the market's pricing at the moment. So unless something really changes, unless inflation turns around in the headline numbers and the core continues to go higher, then I think the market's pretty well set on its pricing for the ECB. If that's the case, I don't see any real reasons why the euro is going to move significantly. Then, obviously, you've got to look at the dollar side. If there's a big change coming in the US, we've seen the numbers coming out pretty positive. It could mean that the economy is hotting up over there. It could mean that inflation might start to find a bit of a bottom and move back up again. If that's the case, then we're going to get a bit move because the dollar's going to strengthen because the market's going to get a bit more hawkish over the Fed. Again, maybe we're looking at 2 more hikes. We're currently pricing around 2 more hikes. If those expectations change and they start to get a bit more hawkish, then you're going to see the dollar gaining broadly around the grounds. Next one I want to look at is dollar CAD. And again, this is really looking at the commodity side of things. Now, the CAD has gained pretty well, and that's been a bit more because of the Bank of Canada pulling out that surprise hike. Well, it was a surprise to some. I was leaning that way that they've been a bit hawkish of late, so it wasn't too much a surprise that they did hike. The question now is, are they going to follow that up with more hikes or go back into pause mode again? So this one has been going a bit against the commodity side of things. If you look at something like oil, oil hasn't done an awful lot, and I'll take a look at that in a moment. But what's happened here is that we've got a bit of a pivot level down at this 132, 132.10 area. We've had the break of 133. We haven't really got close to that, putting a real test of that 133 level just to see if we get a confirmation of that break. But we seem to be making a bit of indecision around this 132 area. It seems that when we get below, we can hold below. When we get above, we can hold above. We've closed the week above it. That gives it some positive signs, but the bounce so far when we got back above 132 was pretty weak, so it's looking a bit dead cattish. To the downside, I thought we might get a bit of follow through when we did break below 132, but it was a bit flaky. It wasn't too convincing. We had a couple of goes at the downside, then we recovered again. We couldn't hold below that 132 area. So technically that was the key marker. If you can't hold a broken level, it puts a bit more indecision in the market. I've got a bigger level down at 130.80, which I was keeping an eye on. Again, something we didn't get close to over the last couple of weeks. That's really a decent level for me. Again, it was another one of those break points where we came up, we had resistance there over a decent amount of time, had a little break, couldn't last. Then when we got a real break, ummed and ahed a bit, and then wallop, off we went. We developed that level up around the 132s when 131s broke. So you got 2 points there, 2 break points there that I was looking at, the lower of which was that 130.80. I'm still keeping an eye on that, but as I say, I think things are a bit more neutral at the moment. We need to know whether we're going to get back below and stay below 132, stay above, and maybe we have a push up and keep in this range that we've seen for the last few months. Looking at one of the crosses, Euro Sterling is obviously one I look at and trade very actively. It has had the bounce up off, didn't quite get down to the 85 handle that I was looking for. I was going to try and get in some longs there. I was being a bit greedy, got down, I think, to 85.14 or something like that. I didn't do anything. We've had a bounce up. It's gone through the levels pretty well. Had some levels around 86, 86.30, 35 into 45.50. Another zone here that I've got from sort of 45 up to the 60s, if you like, near 70s. So another one of those traffic zones where the price can do a bit there. And as you can see on the chart, we had a little move into above the 45 area, couldn't hold it. Straight afterwards, we're finding it as resistance again. So this one, we've got a bit of a range now here, probably around that 86.50 down towards those 85 lows. We need to see what happens here. Again, fundamentally, it's all down to the data. Can the Eurozone, can the ECB get a bit more hawkish? Can the Eurozone data improve, give a little bit of a lift to the euro versus the pound? Or is the UK going to confound expectations again and not disappear up its own backside? The data might be doing well again. We know what's happening with the Bank of England, that they've had to turn more hawkish. What I would say from the pound side is that a lot of this move down, particularly through May, was due to rising expectations for the Bank of England. Now, I think we're getting a little bit extreme in the pricing. There's market pricing I saw this week up about 6.5%, where some in the market are expecting Bank of England terminal rate to get to. I think above 6% is getting really in the extreme measures. So I don't think we're quite going to get there unless, again, the data confirms it by showing it's really sticky in inflation. That's going to force the bank to go higher. As I've been saying this week, I think the Bank of England have got the clock on their side. I think from August, when we get the July CPI numbers, that's potentially when we might start to see inflation really going the Bank of England's way. That will take some heat out of rate expectations. Probably give the Bank of England and Bailey a bit of breathing space, because they are very reluctant hikers there. So fundamentally, I think we're in for a bit more sideways action for euro sterling. I think you need to trade the ranges. We've got a decent level, 87, 87.20. Get to that sort of area. I'm going to be looking at technical shorts potentially from that side. Again, 85s, I'm looking at technical longs just on the support area down there. Obviously, if we get a move to any of those sides, I have to judge the moves on the merits, what's driving the price there, before I decide whether I want to trade or not. Excuse me. As is always important, we need to take a look at yields, particularly for what's going on in the US. And again, a bit of range playing going on here. And this, again, is indicative of where we are in markets now. It's important because we've come through a big hike cycle. A lot of central banks going through hike cycles, pausing, hiking again, pausing, hiking again. They're really not sure. Central banks are really not sure what they're going to be doing next, really, from one month to another. And that's being reflective in things like yields. We've got to a point now where the market is largely knows that we're at the end of the hike cycle. Or if we're not seeing the speed and the size of hikes that we were all through the prior year. So that means volatility naturally comes down. We're not going to see big moves. Now, a lot of people were looking for another move up to into 4% in US 10 years. I was reluctant to get on that bandwagon because I saw no material reason why the market would do that unless there was some sort of shock coming out of left field. Central banks are where they're at. So we've got a bit of a range here. We've got a bit of a pivot line around 3.7% here, and a bit of a line in the sand at 3.6%. On the upside, 3.9% is pretty much the top of our range. If we get above that, then maybe we get a push to 4%. But we came through this week. We came through Powell. We came through the data, everything that went on. We had a little move up to 3.9%, but that was it. We closed the week a little bit lower, pretty much in the middle of that pretty tight range between 3.7 and 3.9. So not a lot to take home from that, except this is how I think markets are going to behave moving forward. Looking at oil, and this one is really surprising me because it's not doing an awful lot. And oil is a quite a volatile commodity, and the fact that it has been pretty much suppressed, it's had a really tight range for a couple of months now. It's pretty unusual for this commodity. I think a lot of this is down to what's going on in the global economy. As mentioned, manufacturing PMIs are looking very weak. They've gone further into contraction in a lot of countries. So there's no reasons why oil should move significantly higher. We've had OPEC members, Saudi Arabia, trying to get the price back up by production cuts. They haven't worked. We had that move back in April where markets gapped up. Then later on, a couple of weeks ago, the Saudis tried to do it again. We had a little gap up, lasted about 5 minutes, all the way back down again. So from the production side, from the OPEC side, they're not doing an awful lot to keep the price up, and their actions so far aren't working. But we're not really making any further downside. So the market does look well balanced here. If I had to pick a side, I'd say that potentially we're looking at a downside move more than an upside move. But I think it's going to need a break of the 66 level down here. If we get that, then we're going to be looking at the 60 level, just coming out a bit wider on this chart particularly. And, if we can really get under this fib, this 65, 66 area, then we've got a bit of a level down at 62s. Under there, we're potentially heading down towards this fib down here. And I think we get a bigger breakdown if we can clear out this traffic and the prior lows down there. But as I say, on balance, I would favour a breakdown rather than a move back up. If you want to trade it, you've got some decent levels in the way. Again, this little bit of a pivot zone here, sort of around 72, 73 bucks. We keep hitting there. We can't break through there. So that's going to be an area you need to look at if you want to try shorts on that side. Down below, as I said, into 66, that's where we can't get through for the moment. So if you're short from up 72s, 66s is where you want to look to maybe take some profits on the table. If you feel like catching a knife, that's the sort of area you want to look at longs. You don't need to give it a lot of risk on these trades. Maybe $50 on top. That's all you need for a stop loss. There's no point having a $5 stop loss trading this real tight range. Have to be aware that if we do get some big news and it does make a big move, then you're going to see maybe $5, $6, $7 tacking onto the price if it's fundamentally driven. Coming across to metals and looking at gold. This one was quite interesting this week. A lot of people eyeing the break of 1900, potential level where we might see a bigger move down, maybe down towards the 1860s area. It broke 1900. It hit this fib here at 1894, give or take a couple of bucks, and it's bounced since then. That looks like very much like a stop run. It's knocked out a lot of the eyeballs that were looking at 1900, maybe getting into shorts, looking for that steeper move on that break. They've ended up with egg on their face. We've had a bounce back up, quite a decent bounce, getting back up towards the 1920 area. Can we hold above it? We've set a marker down here against this fib, so that's going to be a level that you need to keep an eye on moving forward. Those who bought the bounce there, likely to be parking their stops just under that. So if we get another move down there, be on watch for another bit of a stop run. That may be the kicker for a move down towards 1860s, 1870s. Conversely, on the upside, really need to get back above the 1930s area. If we do that, that gets us back into potentially moving back up, maybe towards 1980s, a bit higher, maybe even a crack at 2000 again. But it's all about small steps at the moment for this. For now, though, the trend remains, the short-term trend remains down, obviously. We have made a new low. That is significant. You need to keep an eye on that for the longer term. Again, where do the bounces get to? If we get up to that sort of 1930, 35 area, can't get through, that gives shorts a bit more ammunition to get in again and have a go at pushing the price down below that prior low. So lots in the mix. Very interesting one to look at, this gold one. Interesting to see where people are lining up to trade it and whether they're going to be right or wrong. So over to the S&P, and we're going to take a look at what happened in stocks. And the S&P really breaking the prior high and looking quite positive still. The trend is still your friend with this one, looking very bullish. I see no reason why stocks might falter at the moment. Certainly the fundamentals are showing in the US that things are looking pretty good. We saw that GDP number as mentioned earlier coming in. So the soft landing narrative really playing into this. And something I was looking at right at the beginning of this year is whether we see a definition change in what risk on, risk off means. And for now, as we say, we're getting that better data from the US, and stocks are buoyed by it, because this soft landing means that the lagging effects of monetary policy may not be having a negative impact in the economy that some are looking for. Still might be lagging, so we still may start to see some effects, but certainly the data so far is suggesting that we're not heading for any bumpy roads right now. The jobs market remains very strong, and we're going to take a little bit of a look at that one in a while. So for now, we're making new highs. We broke a high last week. That's hopefully going to hold. We've just closed below that prior high around about the 40s for the week. So it could mean that we may, a bit like dollar yen and the 145, could maybe get a little bit of resistance coming back in around that prior high. We need to see whether it kicks on. What is significant about stocks at the moment is the pullbacks are very shallow. We're not getting much of a pullback. 43.30s was the one we got after that first attempt at that high up at the 44.40s. So looking very weak on the pullbacks, at least keeps the trend in play. This looks like a decent refresh move, which you want to see in a decent trend. If you get a strong trend, you don't want it going parabolic, because the higher it goes without a refresh, then the more volatile the pullbacks can be. So this is a nice, decent trend move. We get the pullback, gives us a bit of a springboard to move on. Maybe we get up to the 45s, 45.16s, just that last highs looking back into April. Levels are pretty clear after that. Got a bit of a level up at into 46, 45, 95, and then a bit higher into the 46.30s. So for now, really until we get a move back under 43s, this trend is going to stay in play. No signs of turning around whatsoever. And as I say, the big data we get this week, which I'll show in a moment, is potentially going to lead to the stock market moving higher if it's pretty good. Just before we move on to that, just want to give you a little bit of insights into what we've got on Forex Analytics. First and foremost, if you want to try and upscale your trading, don't forget to check out the Trader Funding Program. This is where you can come and trade the money of Forex Analytics. You can get up to 90% of those profits, and the balance comes to us. Obviously, we want you to be successful. So part of that Traders Funding Program means you get free access to Forex Analytics. Depending on what size of account you go for, you get longer periods of time. If you take out something like $1 million account, go for that assessment, then you get a hell of a lot of time in the Forex Analytics platform, and we get to help you along that journey. What's good about the TFP is that it's very low risk. If you want to open up a $50,000 account, take an assessment, 50,000, 100,000, you don't have to put that money into the account. You just pay the assessment fee. That is your only risk. If you happen to blow the account later on down the line, all you've lost is the assessment fee. All the other losses are covered by us. So it's a low risk trade for you guys. You only risk the assessment fee all the way through. If you wanted to check us out in the chat room, then you can take up $1 for 10 days offer there, trial offer there for the Forex Analytics platform on its own. You can come in and see us all day today, squirreling away on the trades. And I just want to show you, this is our trade room, which is where a lot of the hard work's done, if you like. This is where a lot of our users put the trades in. It's where I come a lot and put my trades in. The reason for this room is not to say how great we are. Have a look. This is a trade I've done. I've made money, so on and so forth. It's not a victory lap room. What this trade room is where people can come and put their trades in real time. So it's there for a few reasons. One, transparency. Anyone can say, "Oh, I made the trade half hour ago. I made 50 pips." That doesn't help anyone. We want traders to learn. So what we use this room for is providing the insight, why we're trading, where we're getting in, where our stops are, why we're adjusting the trade, why am I taking profit where I'm taking profit. It's to give traders a bit of insight into what goes on behind the thinking of a trade. We do a lot of the hard work in the main room. That's where most of the charts go. So that's where the main analysis is done. But when we enact a trade, you get to see it within good time. We ask traders to post their trades as they do them, not 10 minutes later, not half an hour later. But if the market does move in between the time you've placed a trade and you come into a trade room, then as you can see from Cayman there, we put in our screenshots from our trading platform. So it keeps the transparency going. No one learns it from hindsight. No one learns for just making stuff up. We want people to actually understand the thinking process behind a trade so you can understand how we think about stops and management and things like that. And as I say, you can get that for $1 for 10 days, and then you can decide to move on to a full account if you wish, and we hope you do. Right, so looking at the data coming up this week, and a pretty busy week. Starts off on the Monday where we get the final manufacturing PMIs from Europe, as you can see there, but also we get the big ISM from the US. That's going to be very important for the data dependency trading that we do. Now, it is the US Independence Day holiday on Tuesday the 4th. Markets are closing early on the Monday in the US. A lot of the states will be taking this as a long weekend, so desks are maybe going to be pretty sparse in the trading world in the US on Monday as well. So this data might have a little bit more volatility due to that lack of eyeballs on it. And if it's a big number, then obviously it's going to move markets. So just be aware of that. Obviously, being jobs week, keep an eye on the employment components from that number there. Over on Tuesday, we have the RBA. This is one of the banks that's a bit 50-50 in what the market expects them to do. Will they pause or will they hike again? The market's very split on that. So I think the bank's very split on that. So we pretty much a coin toss for that one. Over on Wednesday, again, more final numbers. These will be the final services numbers from the Eurozone and other countries. We also keep an eye on the NBA mortgage applications just to see how that weekly number's going on in the jobs market. But Thursday's the start of the jobs week, really. We get the Challenger layoffs. That gives us an indication on firms who are looking to maybe get rid of workers. Then we get the ADP, which is always looked at as a precursor for the NFP number. It's not a linear number. They don't tend to one lead to another, but if there's a big variation, that will move the market. And then market will change its expectations for the NFP on Friday. Jobless claims as well. Keep an eye on that one to see if we're going to hover around this 239 that we got last week, or whether we're going to spring back up into the 260s. Then we get more big data, the ISM services number. Now, as I've been speaking about earlier in the video, we have seen this divergence between manufacturing and services. In all the other countries, we saw manufacturing falling back even further, services pulling back a little bit there. Is the theme going to carry on in the US? And again, keep an eye on those employment numbers just for their implications for the NFP on Friday. And then obviously to Friday, it is the big number. You can just see over my shoulder my old life jacket. This was the biggest number of the month down on the floor when I was in the pits. You'd get there 10 minutes before the number was due to drop. The pits would be packed shoulder to shoulder. 10 seconds before the number, you could hear a pin drop. The buzzer went, the number dropped, and all hell would break loose. So always an exciting number for me. It is a big number. We are very data dependent. So I'm expecting this one, if again, there's a big moves in it, to be very volatile. We're expecting 225k this month. It was in the 300s last month. Keep an eye on things like the unemployment rate, expected to stay unchanged at 3.7%. Wages expected to tick down a tiny bit. We're looking for the inflationary aspect from those numbers there. And that ends the week. And just lastly, before we finish up, you can always come and check us out on the various webinars that we put together during the week. You can come and see myself, Stelios and K-Man on the Flow Show every morning in Europe from 10:30 UK time. Then obviously come and join the man, the coach, Dale Pinkett, for the F.A.C.E show. And Blake's going to be back, I believe, from his break this week. So he's going to have no doubt a lot to say and catching up to do on that one. And then if you're a member of Forex Analytics, we do have other shows during the week as well. Daily Roundup, Morning Edge. And if you speak Spanish, keep an eye out for Leandro and his Trufa webinars. He does those in Spanish for any Spanish watchers there. So anyway, thank you very much for having me doing the week ahead video. I hope I've set you up for the week ahead. And good luck with your trading this week. Wish you many pips, and we'll see you during the week. Thank you very much.
Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.